Thank you. I thought that I might win the farthest away award because, as most of you know, I live in San Diego, but since July I've been in Wilmington, North Carolina. Is anybody from North Carolina here? Well, then don't take too much of offense at what I'm about to say, but North Carolina is different than California. I've learned that if a car has a blinker on in North Carolina, it means that they meant to turn somewhere in the last 3 blocks. They may turn somewhere in the next 3 or 4 blocks, or most likely the guy is hard of hearing and the blinker doesn't work. It's a whole different thing back there. I have a lot of time in my hands, so I've been reading the newspaper, and it's fascinating. What I'm going to tell you is word for word, but it's a montage of the personal ads, men looking for women, women looking for men. But the most intriguing one was women looking for men, and it started woman looking for man who enjoys walks on the beach. And then it listed these other things. Well, these are 2 or 3 of them put together, but it started overweight woman and not working on it, looking for a man who enjoys Kmart shopping, flea markets, and does Pizza Hut. I don't know what does Pizza Hut means, but that seems like a pretty cheap date. But probably the most interesting one to me I saw in the newspaper, because I want to go to all the groups and see what's happening in town. Like I said, I've got a lot of free time, so I went to the natural birth control. I wanted to meet some commodity traders, so I went to Gamblers Anonymous because I hadn't many traders. But the one that intrigued the heck out of me, Smokers Anonymous. Now, have you ever seen an anonymous smoker? Is that an oxymoron, a contradiction of terms? But it's really been a joy to be in North Carolina, to be back in a small community and kind of away from commodity traders. So I've done a lot of thinking while I'm back there about what I can talk to you about that might have the most bearing on trading. And after trading for 35 or 36 years now, I think the message is a lot simpler than we thought the message was. And I'd like to begin with the background of what I think of as a real truism. Can you imagine what the world would be like if everybody was rich for a moment? Try to get that in your mind. What would that be like? It would be great for you, right? Except it would be a horrible world. Who would serve your dinner if everybody was rich, right? Who would wait on tables? Who would take videotapes? Who would speak? Who would do? If everybody was rich, the world would be a pretty messed up place, as a matter of fact. So behind that, I have a notion that God doesn't want everybody to be rich in the world. And I'm getting to a point here, so bear with me. You know what it takes to be very, very wealthy? It would be real easy if you could just see the future. We'd all be wealthy, wouldn't we? I mean, it didn't matter. You wouldn't have to trade pork bellies. You could roll dice. You could bet horses. You could start new businesses. And you'd be incredibly wealthy if you just knew what was going to happen in the future. So what I believe is that God really doesn't want us to know the future. Now, those of you who don't believe in God, you don't believe in the future anyway, so my argument's still valid, right? Commodity traders, though, have this great notion that we can predict the future, that the future is predictable. And I'm here to say, after trying to predict the future for more years than I care to admit, that it's pretty hard to predict the future very long, very accurately. In fact, I don't know anybody that's done it. I'll repeat that. I don't know anybody that has consistently predicted the future in this business of stock or commodity trading. It doesn't matter what math model has been used. It doesn't even matter if you look at Hollywood models who thought their career would go one place or another. They didn't hold up any better than the mathematical models did, trying to predict their futures. It doesn't matter how big your computers are or how much artificial intelligence or non-artificial intelligence you had. Nobody has consistently been able to defy the basic principle that God doesn't want us to know the future. Because if we all did, the world would be a pretty mucked up place. That doesn't mean we can't get a little glimmer and a glimpse of it. But when it comes to the commodity markets, I think there's 3 camps. And I want to talk about those 3 camps to see where you are and maybe give you some idea of where you can get a sense of future of the marketplace. The first camp would be what the markets are really all about. The markets, news to some of you, were not set up to glorify chartists and people with computers. The markets don't give two twits about your chart books, about your point and figure formations, about trend lines and moving averages. That's not why the Chicago Board of Trade was set up. That's not why the New York Stock Exchange is there. Those exchanges are set up to facilitate commerce. That's the only sole purpose of them being in existence. Therefore, if that's a basic premise is correct, what that means is the closer you can get to the people that use those markets, the more accurate you're going to be as a trader. So my basic premise is that the commercials in the commodity markets are the driving force of commodity trends. If you can understand what the commercials are doing, you're going to have a lot better idea of what the markets are going to be doing, as opposed to spending time with your computers, with your charts, with uppercase Armand-Going flying boxcar formations. That is the central place of the commodity market. But strangely enough, chartists, what we call technicians, we technicians think that we're the center of the universe, that the markets revolve around us, and they don't. We got a little glimmer of it every now and then, what may happen for 5 minutes until the 3-minute bar chart changes, but we don't have a long-term perspective of the market. And the markets don't revolve around what we do. Now, once you can accept that, I think your life can change radically in terms of your belief of how to trade the market. Now, the most wrong group is then not just us who understand the market a little bit, but the public. The great unwashed public. Some of you, based on the hands that just came up, are still in that great unwashed group. So don't take offense at what I'm about to tell you. But certainly the public are the biggest schmucks in the game. They are wrong probably 90% of the time. And they really prove an interesting point. Has anyone taken economics classes here? Basic rule of supply, demand, and economics is the higher the price, what will happen with demand? The lower the demand. The lower the price, the higher demand, right? That's like economics 101. But if you study what the public does in terms of this business, you'll see the higher a price of a commodity is, the more they buy. And the lower the prices are, the less willing they are to buy. They're always bearish at the bottoms and bullish at the tops. The high price drives the public to buy commodities. Low prices scare the heck out of them. They're always wrong at the extremes. So those three groups, we can use those groups looking at the commercials, that why the markets are really in existence. The markets really do have a commercial function for them, and you can learn and follow that, and I've talked about that for years. I'm not going to berate that too much this evening. And then the opposite side is a public who's almost always wrong in the market. And that's the other side of the coin to look at, because if you've got somebody who's almost always wrong, hey, you're home free, right? Jake Bernstein will probably tell this story tomorrow, maybe not. His ultimate moral dilemma was he had a customer in his brokerage firm who had 21 out of 21 losing trades. Guy ran out of money. Jake's moral dilemma was, should he just give the guy $20,000 to keep trading, because he could make a lot more than that taking the opposite trade. Jake decided not to do that wasn't quite correct. Some of you may feel like that's even been you in the market sometimes. But those are the two extremes, the two camps that I think you need to look at for longer-term moves. Now, the only thing that really is predictable about the market, I'll tell you, is this. Some market in the next 12 months is going to have a big move to it. That's an absolute God-given fact. But we don't know which one. That's a bit of a problem, right? That's why trend-following systems work to an extent. If you have a basket full of commodities and you trade every one of those commodities with a trend-following system, guess what? You'll probably make money. But you can't predict which one's going to trend, for sure. So people that have long-term trend-following systems will simply toss a bunch of commodities into a basket, and they'll buy a cross out of every 20-day moving average and sell every 20-day moving average break, whatever the trend mechanism is, and eventually that basket will work out. The turtle method, which some of you heard about, my good buddy Russell Sands follows, really he'll make money probably most every year, because he's in a large basket of commodities, and one of them is going to trend. pays off the other losses. My view is if you understand what the commercials are doing, you can be more selective and say the trending markets will probably be this market, and this market. Because the commercials have acquired a huge amount of whatever the market happens to be. So we can narrow it down by looking at the commercials. That's one way you could use the commercials to narrow in. Certainly the Commitment of Traders report came out yesterday as the most dominant long-term influence that I know of for long-term commodity trading. But the problem, of course, is you people don't want a long-term commodity trade. You want short-term trading. Is that right? How many would like to be short-term traders, leave their jobs and just short-term trade? Usually, those are the calls I get all the time. I want to be a day trader. I'm doing so well with my long-term trading, I want to be a day trader. I said, gee, why do you want to lose your money? And people get upset, you know. When day traders call up, they think that probably I went to the Marv Albert School of Charm. I don't know. Don't feel bad for Marv. I was on the plane flying out with him today. Apparently he's got a new job as head spokesman for Fredericks of Hollywood. For those of you who follow sports. Last week, a publishing company came and wants me to write a book. And so I want to write a book about this. And they said, no, Larry, short-term sells. That's what the public wants. But the interesting thing is the calls that I get from people continually are they're taking short-term trades and they're losing a lot of money. So very short-term trading, I think, and this just be my limitation, is very, very difficult to do. And I've done it. When I took the $10,000 to $1.1 million 10 years ago to win the Robbins World Trading Cup Championship, a lot of those were short-term trades. It's a terribly fatiguing job, and you got to be very good and very sharp all the time. You have to be high on caffeine, 12 hours a day. It's that demanding of a thing to do. So generally speaking, I would suggest that you stay away from the lure of instant wealth. It's easy to make money. It's like falling off a log. It isn't. If you get nothing else out of my presentation, this is a damn difficult business, folks. I don't know if you're nodding your head. This is a tough business. Trading commodities to make a substantial living is a business, and it can be a very hard business. But that's not unusual. Does anybody know a way to make money real easily without any work, pain, risk, effort? Anybody does. I'd like to talk to you and buy your business in a heartbeat, right? Whenever you make money, there's effort, there's work involved. This is a neat business in that you can learn to do it paper trading. We were talking earlier this evening about it, and that's one of the thrilling things about this. The only business I know where you can trade on paper for a long time period till you learn to master the skills. Can you imagine if you were a lawyer and you thought, well, I'll just kind of paper trade, for a while until I figure out what to do? You'd be a better lawyer than just your first day in court, day one out of law school. One of my very best traders is a guy who was a professional race car driver. He paper traded for 18 months before he started trading. And he mastered the skill of paper trading and then went on to trading. So I would suggest that you do a lot more practice than you start immediately trading the markets. But I know you people, you love to trade. Trading is so much fun, right? Isn't that a great thing you like to trade? It's fun, isn't it? It's like sex. You don't have to be good at it to enjoy it. That's commodity trading. And it's so much fun we get carried away with it, primarily because we have a general belief system. See, you people in this room, you are not like the people on the other side of those doors. You people don't mind risk. You people are in the marketplace because you enjoy risk, you enjoy rush in your life, you enjoy some thrill in your life. You're probably a lot smarter than, well, maybe they're smarter than you on the other side of the door. I don't know. And there's a common belief system, I'll bet, running around this room, and that belief system is, I'll prevail. I'm going to get through this. I'll hang in there. The all-American dream, I'm going to do this. And that is a killing belief system. And I'll explain why. The best belief system that I can impart with you would be this. The best belief system that I've developed in trading over these years is I absolutely, positively believe my next trade is going to be a big loser. I don't believe positively. I believe it's going to be a loser. Now, think about that. Who's going to protect their capital the most? The guy who says, oh, this is the one that's going to pay off the mortgage? Or the one that says, this is going to be the big losing trade? That belief system is a very empowering belief system. If you believe the trade you're in is going to be a losing trade, you'll protect yourself a lot more. Most people lose money because one trade gets away from them. Maybe two trades get away from them. And those one or two losses become so gargantuan, so huge, that it wipes out everything else that they've done. They've had 9, 10 winning trades. They get this, what I call the King Kong feeling. Remember King Kong? He climbs the Empire State Building, which is now the World Trade Center, right? He gets on top of the King Kong building, and he's got the Jessica Ray or whoever it was in his hand. He owns the world, and then they kill him. And that's a feeling of you're so successful trading, you think, I finally got it figured out, and instead of buying one contract, you buy 35. Yeah, and that's the wrong thing to do. It's King Kong. Brrr, they come, the helicopters, and you're dead again. But if your belief system is, hey, I got to be careful about this, that I'm probably going to lose on this trade, but underneath that belief system is a corollary belief that I will succeed over a long time period based on my short-term belief that I better watch out for this trade. I mean, clearly, I'm not pessimistic about what I'm going to do. On a long-term basis, I'm very optimistic. But on a short-term basis, I've got to protect myself from losing money. And most people can't spin on a dime quick enough in this business. They fall in love. Have you ever had a trade on and you just fall in love with it? I mean, you don't even know why, right? This is worse than marriage. All of a sudden, you didn't even want to be in the trade to begin with, and now you're stuck with it. And you'd be damned if you're going to give it up because it's got to go higher. Everything you have tells you it's going to go down, but you hold on to it. That's the emotional part of this. And you have to be able to cut that emotional thing out and say, look, I don't have any belief systems where the market's going to go, but it goes to this point, I'm out. Because ultimately what this game is about is protecting your money. Sure, it's about trying to predict the future, but that's pretty tough to do. But the one thing you can do, regardless of who you are or where you live, is you can protect your money. And I'm going to show you in a little bit why that is so terribly important. If you can protect your money at all times, then I think you can come out ahead as a commodity trader. All you really need to do as a trader is this. This is the big secret. The big secret of commodity trading is real simple. All you have to do is find an advantage in the game and then work that advantage. I'm going to teach you some of those this evening. If you just find an advantage, it doesn't have to be a big advantage. You don't have to be right 80, 95% of the time. You can be right 50% of the time. You don't have to be right very often. Think of the casinos in Las Vegas. What's the advantage they have in the game there? In roulette, I think it's real high. It's 5%. In craps, it's maybe like 2%. And it's a negative expectation probably in blackjack. But they got a little tiny advantage, 2-3 percentage point advantage. And slot machines, 3% advantage. That's all they have. It's a little tiny 3% advantage. Have you been to Las Vegas recently? Have you looked at the hotels they built on a 3% advantage? Gargantuan empires on a 3% advantage. Commodity traders are out there looking for the Holy Grail with a 100% advantage. You don't need it. You have to get an advantage, which the casinos have, and then you have to work it. And the casinos do that really well. They really work the advantage. They're going to give you a free buffet with the prime ribs and the steak and lobster tails and fly you in and comp your room. And the whole thing for that lousy 3% advantage. They'll even let the kids go to an amusement park. And they don't just keep the casino open for like 2 hours a day. That was the big thing they did in Las Vegas. Prior to Las Vegas, casinos were open, even now, most throughout the world. They open at 8 o'clock at night and close at maybe 12 or 1. That's it. In Macau, off the coast of China, I think they open at 9 and close at 2 in the morning. And in England, they open about 10 o'clock at night and close at 3 in the morning. Very limited time period. But Las Vegas says, hey, we got an advantage. We're going to work it 24 hours a day. And that's why they made the fortunes. That little 3% advantage, but nonstop, no clocks. Keep everybody awake. And I think we commodity traders can learn a lot from that. You need to get an advantage in the game, and you need to work the advantage. I'm going to show you some advantages, and then I'm going to show you how to get the advantages in the game as well. So let's talk about how you can get an advantage in the game. There's a great advantage you can get in the game of trading stock index futures. I'm going to talk about that, and then I'm going to talk about trading the bond market because there's a couple of advantages I'll give you there for trading the bond market. The first one there, we're going to talk about buying the S&Ps. I'll give you a real simple S&P system that you can trade and probably start to trade it also on the Dow Jones. The Dow is going to start trading, which I think is really an exciting trading opportunity coming up here. And you have the new mini S&P contracts. Here's a real simple system. Hopefully you can see it from the back. If not, I'll go over these numbers for you. Notice that this particular system's had 194 trades. 55% of them have been accurate. It had a drawdown of $6,000, and it made $67,000 since 1982. So we've got a long time period. The system's held up pretty well. And this is a day trade. We buy in the opening, we get out in the close. So we held nothing overnight at all. And this is a simple system I've taught probably 10 times a year for the last 10 years. There's nothing complicated to it, as you'll see in a moment. And it does okay. It makes some money. Average profit per trade is $347, and no overnight exposure to it. It's not a bad little system. I'll give you the rules for it. You're more than welcome to have those. Oh, maybe I left the rules at home. No, I wouldn't do that, would I? The rules are we're going to buy on Monday if and only if the S&P's open down for the day and bonds are the 18-day moving average of bonds is higher than it was yesterday. I think that's what we're doing. Yeah. That's all there is to it. So if the bond market is in an uptrend and the S&P is open down on Monday, we're going to buy on Monday, have a protective stop, and get out on the close. Our protective stop is $1,725. But there's a huge advantage to the game. When the bond market's in a strong uptrend, then the S&Ps most likely will rally. And usually, the S&Ps rally on Monday. They usually open down and then rally. So we know we've combined a day-of-the-week phenomena, which has held up for a long time period. Mondays tend to set up a low in the marketplace, with another intrinsic factor: the bond market drives the S&P market. Now, that's something real to deal with. That's not a trend line on a chart. That's not a WD-GAN 46.7 resistance line that somebody drew with a felt tip pen across the top. It's real. There's a real relationship between bonds and the S&Ps. Those things matter. Huge amounts of money are invested based on those differences. And we can use it into our application here, where we see that it does pretty well. It makes a little bit of money. And I'm going to give you another system as well for those of you that are really into systems. This system trades the bond market. And there's a market that drives the bond market. Here, this system's got, since 1990, 107 trades. 82% of them made money. The average profit is $642 with a $5,600 drawdown. So this one's highly accurate. It makes about the same amount of money as the S&Ps. And the rules for it are real simple. I'll give you the rules for this as well. You might want to write these down. If day of week is 5, in other words, if it's Friday, and the close of date at 2, that happened to be gold, is less than 5 days ago, and we open down on Monday, we'll buy Monday at 15% of the previous day's range. That's one rule. I'll repeat that again for you. You might want to take note of this. If it's Friday as it is today, and gold is lower than it was 5 days ago, and we open down on Monday, you'll buy Monday at 15% of Friday's range added to the opening. The reason for that is simple. Gold drives the bond market. Huge correlationship. Go to Murray Ruggerio's seminar. Murray will talk to you about that. Gold is the underlying thing that propels a lot of markets. The relationship between gold and a lot of markets are critically important. And there's something real going on here. This is not chartist mumbo-jumbo. Money has a choice, buying interest rates or putting it in gold. Where does it go? You can follow the flow of money between those two things, and all those things like, lo and behold, if gold is down, then buy signals and bonds work better. I don't care what your buy signal is. I don't care if it is the most arcane, occult, technical thing in the world. If gold is in a downtrend, your bond buy signals will work better. So now we're trading with real information, with reality, not some conjecture of technical talk. When gold is down, bonds tend to rally. By the same token, when gold is strong, bonds tend to decline. Oh, how about Thursday of this week? Did anybody know what happened in the gold market? Gold starts to rally, bonds got dumped, got hit real hard. Why? Because of that relationship. It doesn't have anything to do with the conjunction of the planet Mars and Saturn at 16th conjunctile or whatever that stuff is. It had to do with the relationships going on in the marketplace. And that's what I study. I study those relationships so religiously. There's a tremendous impact they have. Now, there's another part of this system that I just showed you, and that's a seasonal trade. Bonds are also very seasonal. Again, I've lectured on both these points for years. If the trade day of the month is 12, 18, or 21, we're going to buy, and bonds are lower than 15 days ago. I'm sorry, gold is lower than 15 days ago. We'll buy bonds tomorrow on the opening. So we know there's a strong seasonal tendency for bonds to rally around the 12th and 18th trading day, and for sure around the 21st trading day. But I won't take all those. If gold's in a downtrend, then I'll take a seasonal trade. Those work a lot better. If you wanted a seasonal sell in bonds, you'd reverse it. Gold in a strong uptrend, that's the time you take your seasonal sells. So we're taking a technical thing, seasonality. I was the first person to write a book ever on the history of commodities on seasonal tendencies in 1970 or 74. So there's a whole cottage industry of seasonal stuff out there now. And sometimes seasonals work. How many have traded seasonals? About half the time they work, right? The other half they don't work. You want to flip it? Same thing. However, we can ferret out the better ones by using something that's correlated to that market. In this case, gold correlated to bonds. So if bonds are in a downtrend, if gold is in a downtrend, it's lower than it was 15 days ago, and the trading day of the month, and I'll clarify that, we have trading day 12, 18, or 21. That doesn't mean the 12th day or the 18th day or the 21st day. It means that the 12th trading date of the month, which could be the 15th of October, or it could be the 16th of October. It's a trading day, not calendar day, is my point. That's some work that Ken Hornbrook did that was been very helpful. So we're going to look at the trading day of the month, and those seasonal trading days backed by the relationship of gold are what created the signals here. That's all there is to the system. Pretty simple, huh? Now, here comes the breakthrough. What this business is really all about is money management. So there's a basic little simple system that I showed you. I'm sorry? Stop on that's about $1,200. In the S&P, if we use some simple little money management rules, that $60,000 suddenly can change rather radically. In this case, over that same time period with a form of money management, the $61,000 I think it made makes $3.2 million. Grasp that concept. We took $60,000 to $3.2 million in the same time period, same simple little system, nothing complicated to it, no magic, no mysticism, nothing. So my point is money management is far more important than the system. If you're not properly managing your money, you're not with it. That you don't need much of an advantage in the game to succeed. These systems are not great systems. These are like throwaway systems. Give them to somebody on the street corner. But with just a little bit of money management, they make a fortune. Let me continue to demonstrate that point. Here's with a slightly different form of money management, same system. Here the account balance goes to $17.8 million. Same time period, same system, Almost $18 million. Whoa. Did you wake up yet? That's basically what happened 10 years ago when I took the 10,000 to 1.1 million. I used a form of money management. I really didn't know for sure what I was doing. I do now. And I'll give you some money management formulas that you can take home with you. But just to really get your attention, I want to show you something else too. Because a lot of times people see these numbers and say, oh, that's just computer printout stuff, da-da-da-da-da. Okay. Here's an account this year. The account starts at $10,000. After 1 month of trading, the account is at $9,281. That's the end of January. End of February, it's at $15,000. The end of March, it's at $17,000. At the end of April, it's $21,000. At the end of May, the account is $19,000, is growing here. At the end of June, it's had an equity slip down to $14,000. Not a straight path to heaven. It's end of July, it's at $26,000. At the end of August, it's at $52,000. And 1 day ago, it was at $62,000. $10,000 account. $62,000 in September. Traded by a 16-year-old kid. How does that make you feel? Real good, right? Happens to be one of my daughters. Sarah, you should start trading. That just has followed a hotline, that's all. Just a simple, stupid hotline. No big deal. Everybody else has had access to the same hotline. Nobody else has had the same performance. But Michelle did it with money management. It's all been done with money management. So does this work in reality? Yeah, it works in reality. I started trading an account this year at $50,000. It was almost $500,000 through Monday of this week. Not because of any brilliance I have. I'm not a brilliant guy. I don't know what the markets are doing 98% of the time. I'm no whiz kid. But I finally learned how to manage money a little bit. And all you need is a very small advantage to build casinos. That's all you need is a little tiny advantage in the game. So if there are questions while I go along, please feel free to raise your hands and ask the questions too. Please. You're going to have to walk up here. I can see the hand up and that's about it. At my age, I can't hear, I can't see. Yes. Oh, of course. I'll explain. That's the expensive seminar tomorrow. I'm not that kind of guy. Yeah, I'll explain that. Please. Oh, I think silver probably has an impact, but gold is the big one. Silver maybe has an impact on bonds. CRV has an impact on bonds. And what I found is, generally speaking, most markets relate a lot to all markets, except all markets relate to interest rates. Because think about this. Money could always go into something safe like T-bills or something speculative like, my love, pork bellies. So I follow that movement of money between those two markets. And it's astounding what you'll see. You say, oh, money is leaving the gold market and going, or the interest rate markets and going into pork bellies. Pork bellies are going to get strong, and vice versa. So I really pay a lot of attention to that. Those relationships, and you know what? It makes you feel so much better when you're trading. I mean, you guys aren't trading, most of you aren't trading size. But you start to buy 100 or 200 bonds, and each tick suddenly becomes worth like $30,000. When I was trading at the most, I was trading a couple thousand bonds. Each tick was worth $64,000. It focuses your attention. Oh, pork bellies are just, I have this thing about pork bellies. I grew up trading pork bellies. There's a lot to learn technically in the belly market too, I think, coincidentally. But I feel better if I know I'm buying bonds or selling bonds because of a reason, not just one more line on one more chart. I say, hey, something's going on in this market. It could still be wrong, but I feel much more comfortable going with some Dirty word, fundamental reason. I know you people all want technical magic, and maybe we'll do some technical magic tonight, but technically speaking, I'm not nearly as comfortable as I am when I'm trading something that's fundamental, with some technical tools on top of it. Now, the technical tools on top of it would be money management. Now, what time is it here? I've got East Coast time still. 7:30? Okay. The money management is the big breakthrough in software was a couple of years ago when Omega and Bill Cruz did TradeStation and Supercharged and System Writer. We could analyze the markets like we'd never been able to analyze them before. Just recently, a guy named Mark Thorne put together a money management program that just blew me away, and that's what all this is from. We can take a look at that simple bond system. Look what happens. The simple little system that I just gave you goes from making $65,000 to hold on to your seatbelts, $40 million. Of course, you're trading, I don't know how many thousands of contracts, too many, but it proves the point. Money management took it with a 38% drawdown to a $40 million profit from 1990. The way I like to trade it, I'll show you what it did. This, incidentally, is taking your account balance times a percentage, dividing that by margin. And so if your account balance is, say, $20,000 and you want to risk 50%, 50% of $20,000 is $10,000, you divide that by margin, and that's how many contracts you trade. And there's a lot of ways. One way I used to teach that I thought made a lot of sense was like this. This shows the account balance, how much money is in your account, times a risk factor, which is going to vary for all of us. This case would go 60%, 50, 40, and 10% risk factor. Then you're going to divide that amount of money by the margin it takes for one contract and the drawdown the system has. Because that made a lot of sense. Well, we might have drawdown, but we always need money for at least one contract of margin, so we take your account balance times whatever much you wanted to risk and divide that by margin and drawdown. And now it only makes $1.1 million. Well, now we went from, $40 million down to $1.1 million. See, it's important you understand money management. More important that you understand money management than understanding what makes the markets move. My preference is along this line that kind of tames everything. And that is something I will explain in detail to you now. This is going to be the account balance. I'll write this out for you. This is your account balance times your risk factor. And this is going to vary for how much you want to risk. Some of you will want to be more aggressive than others. You might want to look at Ralph Vince's book, Optimal Left, to get an idea of what can happen with these numbers. Brilliant, brilliant kid. Brilliant, brilliant guy. Great work that Ralph's done. Some will say, hey, I like this system. I'm more of a cowboy than another guy is. So generally speaking, though, about 20% is a real good number. So we'll just take that as an example. Let's say your account balance is $50,000. And your risk is going to be 20% or $10,000. That's how much you're going to risk at any given time. Now we have to do something else that Ryan Jones wrote about, and also Ralph. There's a critical number here. This is the most critical number that I can tell you this evening. So pay attention. The most critical number I can tell you in evaluating a system is simply this. What's the size of the largest loss? Because I assure you that largest loss is looking for you. And the sooner it finds you, the happier it will be. That largest loss is just like the goblin out there. Just love to come gobble us up. That's what you need to protect yourself against. Not drawdown, but largest loss. Because otherwise what happens, notice what I'm doing. As I make more money, I'm buying more contracts, aren't I? As I make more money, I've got 100 contracts. I make some more money, I got 200 contracts. I make more money, I got 300 contracts, and then the goblin comes. I have my largest losing loss of $10,000 on 4,000 contracts. And in 1987, that account that started at $10,000 that went to $1.1 million, actually along the way it was $2.2 million. It dropped down to $700,000 because the goblin found me in October, interestingly enough, just about Halloween time. And the goblin just loved to find me. And the account dropped to $700,000 and traded back up to $1.1 million. The goblin that I wasn't aware of, I knew there was a goblin out there. I heard things go bump in the night, but I didn't know what they were or where they was. But I found that out, and now it's the largest losing trade. So if you see a system that looks pretty good, but it's got a largest losing trade of, say, $10,000 in it, the system probably isn't what you think it is. Or you've got to manage your money differently. Because a system that has a $10,000 losing trade and makes $60,000 is a whole different breed of cat than a system that makes the same amount of money with a $1,000 largest losing trade. Big difference. Look at the numbers. I mean, if my largest losing trade is, say, $10,000, largest loss, is $10,000, I'm only going to trade one, aren't I? I've got to divide $10,000 by this, by largest loss. I'm going to trade one. If my largest loss is $1,000, I can trade 10. And usually what I did, and I've done this, I know wherever I speak, I'd be trading a largest losing trade at $10,000 with maybe 10 contracts when I should have been trading with one. But I had 10. So when the largest losing trade, it puzzled the heck out of me. So often I take a little account, $2,000 to $60,000, $70,000, $80,000, $100,000, and boom, all of a sudden they're down to 30. I thought it was just me. I thought it was just God trying to give me another lesson in humility. But after so many lessons, I figured it wasn't just that. It wasn't anything personal. But we really started looking at this and found out what it was that largest losing trade was killing me. Once you know what your largest losing trade is, you're way above the rest of the pack in terms of money management. And the interesting thing about it is you're never going to get tagged for more than about that amount of money. So the basic game plan is, as you make more money, you're going to have more trades on. As you lose money, you're going to cut back your number of trades. The other nice thing that Mark's been able to do with the software is to go in and see if you've had 3 winning trades in a row, do you want to buy more on the next signal or less contracts on the next signal? Wild stuff we're finding out. In most good systems, if you've had 3 or 4 winning trades in a row, you want to buy more contracts on the next system, on the next trade rather from the system. If you've had a bunch of losing trades in a very good system, then there's also a point where you want to buy more contracts because the system's going to get back in phase. It's out of phase, it's going to get back in phase. So it's really opened my eyes to what you can do with money management. Have a more consistent return, as you saw in Michelle's account. That's trading the Robbins World Cup Trading Championship with like $50 or $60 commission already charged on top of that to create the profits that she's got this year. And that's a high vigorish, but that's the trading championship. And interestingly enough, in the trading championship, at times she hasn't always been number one. There's somebody else way ahead of her, but you could see no money management blew the account down. But what you really want is consistency in life in whatever you're doing, whether you're a preacher or a teacher or a doctor. You want to be consistent in what you're doing. Money management allows you to be consistent. The only defensive mechanism we have is a shield of money management. The only thing you can protect yourself from this business is a shield of money management to protect you from the markets. And that's what money management really offers you, as a shield. A question? Yes, Ralph Vince's book called Optimal F. F is in Frank. And it's got a lot of math involved in it. If you're not deeply involved in math, you probably won't understand much of it. But it talks a lot about what Ralph and I did in the old days, and we've since learned. Ralph really honed in on this largest loss thing. That's what was killing us. And thanks to Mark Thorne's software, which you can probably see, I think Genesis might have it over there or tell you about it. you can now go in and you can run the very different scenarios and see what happens if we do, if we treat it differently. Here we're taking the absolute, this made what, $42 million with a 40% drawdown. Here's the account balance divided by just margin, and we get different results. You see we make $40 million, but you have a larger drawdown. The trade-off is where is your drawdown versus how much money you make. I mean, you might make $1 million, but if you're going to go through a 90% drawdown, most of you can't handle that. Most of you can't handle a 90% drawdown. So you can find out with your system what your drawdown ratios are you're comfortable with, and then figure that's your game plan to trade your system with, whatever your system is. But my biggest point is it really doesn't seem to matter that we know the future. That the future is largely not predictable. You just get a little advantage in the game, and I've shown you a couple of very simple advantages tonight. Bonds back the S&Ps. Gold backs the bond market. There's a strong seasonal tendency in the bond market. But two real basic elementary things. I mean, it probably teaches in college even. Kids just don't take notes. But you took notes tonight, so you got a couple of really pretty good trading systems. Putting the money management behind them is what's going to accentuate your appreciation of your account. And it doesn't matter if you take my stuff or any of these other things you're going to see here at the expo, as long as it's based on a valid reason why it should work, then money management will elevate you to the next level of wealth. But without money management, you know where you're going? You're going no place. You're going out of here. I've seen traders come and go, thousands and thousands of traders in the 35 years I've been doing this. And the commonality of losing traders is emotional and no money management. They don't have a clue what to do with their money. They just like to do it. It's like I said, it's so much fun to trade. Dostoevsky, the great Russian poet, said the greatest thrill in life is making money. The second greatest thrill is losing it. And he's right. Isn't it fun to get out of a losing position? It feels so good. Oh, I know. Get the monkey off your back. And your mind kind of gets those two confused with each other. But correct money management will make certain that monkey on your back isn't too big and you still have capital left to trade the game. So I hope that what I've shared with you tonight is informative, that the markets are terribly risky. They're filled full of risk. This is a hard business. And all you need to succeed, you don't need to see the future. You don't need to consult crystal balls and oracles. All you need is a little advantage in the game. Find it, whatever the advantage is for you, and milk it. Work that advantage with money management. And if you do, I think you're all going to become what I'd like to see you all become, and that's highly successful and profitable commodity traders. Thank you for your attention. If you have questions, I'll be around. Feel free to come on up and ask them. Thank you, Ron. And thank you, Ron, for having me very much.